Thank you, and welcome back to the Briefcase, where we talk all things business, investing, and real estate. Today we'll be talking about how the wealthy use real estate to pay almost no taxes. And this is all legally. If you're paying full taxes on your income, you're playing the game wrong. The wealthiest real estate investors legally pay far less, and today I'm breaking down exactly how they do it. Now let's get one thing straight right away. This isn't about loopholes. This is not about hiding money, and it's not about doing anything shady. This is about understanding how the tax code was designed to work and then actually using it. Because here's the reality. The IRS doesn't reward income. It rewards behavior. And one of the behaviors it aggressively incentivizes is owning real estate. Remember, there are people paying 30, 40, even 50% of their income in taxes every year, while there's others that are structuring their investments strategically, where they can legally reduce that number to almost 0%. This is the same country, same tax code, but completely different outcomes. So in this video, I'm going to break down the exact strategies wealthy investors use, not in theory, but in the way that you can actually understand and apply them. So let's start with the foundation. Section 1. This is the big picture and why real estate wins. The tax code is over 70,000 pages long, and buried inside, it is a very clear message. If you build, own, or improve real estate, we will reward you. Why? Because real estate drives the economy. It creates jobs. It creates housing. It builds infrastructure. So the government says, if you take on that risk, we'll give you the tax advantages. Now compare that with the W-2 employee. You earn income and it's taxed immediately. No flexibility, no timing advantage, no leverage. Real estate investors, they get deductions, they get deferrals, and they get depreciation. And most importantly, they get control. That's the difference. And everything we're about to cover stems from that one idea. Strategy number 1. This is depreciation. Now on paper, the IRS assumes that buildings wear out over time. So they allow you to deduct a portion of your property's value every year, even if that property is actually going up in value. Let me say that again, because this is where it clicks. You can make money and still show a loss on your taxes. Now here's a simple example. You buy a commercial property for $500,000. Now the IRS doesn't let you depreciate the land, only the structure. So let's say $400,000 is allocated to the building. That gets depreciated over 27 and a half years for residential and 39 years for commercial. So let's call it roughly $10,000 to $15,000 per year in deduction, or depreciation rather. Now imagine this. Your property generates $20,000 in cash flow. Sounds great, right? But after depreciation, on paper, you only show about $5,000 in taxable income, or sometimes even less. So while your bank account is growing, your tax bill is shrinking. That's the game. And this is why real estate is so powerful. It separates cash flow from taxable income. And most people only think about income. Wealthy investors think about taxable income. Strategy number 2, cost segregation. Now let's take that concept of depreciation and turn the dial up. Because depreciation alone is powerful, cost segregation is where things get interesting. Here's the idea. Instead of depreciating everything evenly over 27 and a half or 39 years, you break the property down into components. Things like lighting, flooring, HVAC systems, appliances, or electrical systems. They can often be depreciated over 5, 7, or 15 years instead. So instead of slowly spreading deductions over decades, you accelerate them into the early years. So let's go back to that same $500,000 property. Without cost segregation, you might get $15,000 a year in depreciation, with cost segregation, you might get a look like 50,000, 60,000, or even $80,000 in paper losses. Same property, same income, completely different tax outcome. Now imagine you made $150,000 at your job. That cost segregation study could potentially offset a huge portion of that income. This is why high income earners start paying attention, because now that real estate isn't just an investment, it becomes a huge tax strategy. Strategy 3, this is real estate professional status. Now we're stepping into what I consider as a game changer, because everything we've talked about so far is powerful. There is a limitation. If you're a typical investor, your losses are considered passive, and passive losses can only offset passive income. So if you have a W-2 job making $200,000 a year, those real estate losses might not help you unless you qualify as a real estate professional. Now this isn't a job title, it's a tax classification. To qualify, you generally need 750 hours per year in real estate activities and more time in real estate than any other profession. Now here's where it gets strategic. Many high-income earners don't qualify themselves, but their spouses do, which means one person earns the high income and the other qualifies as a real estate professional, and suddenly those massive depreciation losses from that cost segregation, they can offset active income. And that's how someone making $300,000 plus can legally bring their taxable income dramatically down. This is where strategy meets structure. Strategy number 4, the 1031 exchange. Now let's talk about scaling, because reducing taxes is one thing, avoiding them while growing your portfolio, that's next level. Enter the 1031 exchange. Here's how it works. You sell a property. Instead of paying capital gains tax, you reinvest the proceeds into another property, and the taxes, they get deferred, not forgotten, but delayed. And in investing, timing is everything. Let's say you bought a property for $500,000 and you sell it for $800,000. Normally you'd pay tax on that $300,000 gain. But with a 1031 exchange, you roll that full $800,000 into your next deal, which means you have more buying power, more leverage, and more growth. And investors repeat this process over and over again, scaling portfolios while continuously deferring taxes. And here's the kicker. If structured property, those deferred taxes can potentially be eliminated through estate planning. And that's how wealth compounds across generations. Finally, we have a case study. Let's bring all this information together. Let's say we have an investor. They have a $150,000 salary, and they buy a $600,000 property, and they perform a cost segregation study. For year 1, they generate $25,000 in cash flow, but on paper, they show a $70,000 loss. Now combine that with a real estate professional status, that's $70,000 that can offset their income. So instead of being taxed on $150,000, they might only be taxed on $80,000 or less. Same income, same year, completely different tax bill. That's not luck, that's strategy. Finally, a quick fun fact that might actually change how you look at real estate and taxes. Did you know a wealthy real estate investor can make hundreds of thousands of dollars in actual cash flow from a property and still show zero taxable income on paper? Here's how that works. The IRS lets property owners take something called depreciation. Basically, even if your property is going up in value in the real world, on paper, the government assumes it's slowly wearing out and lets you write it off as a loss every single year. So imagine this. You buy an apartment building. It's making you $200,000 a year in profit. But thanks to depreciation and other deductions, your tax return might show that you made nothing, or even lost money, which means you can be making real cash and legally paying little to no taxes on it. And here's the craziest part. When wealthy investors sell, they often don't pay them either, because they use something called a 1031 exchange to roll the profits into a new property and defer taxes again. So while most people are taxed when they earn, and taxed when they invest, and taxed when they sell, real estate investors can sometimes legally delay taxes for decades. That's not a loophole. It's literally written into the tax code. Now you're starting to see why the wealthy love real estate. Thank you for watching. And if any of those tax information loopholes were confusing or insightful for you, please leave a comment down below. And if you enjoyed this video, make sure to like and subscribe. And remember, stay smart.